Brokers Alliance and the National Insurance Clearinghouse present the Business Insurance Zone, a Bravo video event. Broadcasting in HD 1080p on Vimeo, YouTube, the Insurance Newsnet, Agent Navigator, brokersalliance.com, and on Facebook, LinkedIn, Twitter, and the Insurance Forum. And now your host, the Wizard of Biz, Steve Savant. Well, welcome everyone to the Business Insurance Zone, the talk show that spotlights insurance in your practice, keeps you up to speed on insurance news and products, features insurance strategies from top advisors. Get in the zone, the Business Insurance Zone.
Our email address is thebiz@brokersalliance.com, or you can call us at 1-800-290-7226, extension 147, for any quotes or questions you have on life insurance, DI, long-term care, annuities, or group pension plans. And remember, I'm not a tax or legal advisor, so before moving forward with anything that you hear on the show, always touch base with your CPA or attorney. And if you're with a broker-dealer, always check in with your compliance officer. Well, today we're talking about group pensions, and with that, our head of our division for group pensions, Susan Hayek, and I just want to welcome you to our show.
Well, thank you, Steve. Thanks for having me.
I do, and if you want to talk to this lady, and you'll want to after we're done for this first segment, you can write her at susan.hayek, but I'm going to have to spell that, H-A-J-E-K at brokersalliance.com, susan.hayek at brokersalliance.com, and her extension 1-800-290-7226, extension 149. Welcome to our show, Susan.
Thank you, Steve.
You know, we're talking about group pensions, and a lot of our producers kind of shy away from doing all that is group. And one of the reasons why they shy away from it is because there's a lot of technical parts of the code. I mean, I hear people saying, well, the Pension Act in 2006, it changed the planet. Well, if you didn't know pensions before that, maybe that's a good thing.
You're right.
You're ahead of the game, right?
You are.
So you could say everything pension, the genesis, the Adam and Eve started in 2006. So you can kind of push what you learned before because it all changed.
Well, it did all change. Obviously, ERISA, the Economic Recovery and Income Security Act of 1974, as we know it, kind of established retirement plans that we know today.
Were you even alive in 1974?
Yes, I was, but
Barely.
I was very young.
Very young.
Very
okay.
young.
And even then, were you reading tax facts?
No, I was not.
Okay.
I was much younger than that.
Well, when I'm looking at where we want to introduce people into basic ideas of retirement plans, and when I think of basic retirement, I only think of, well, 401k, simple IRA, but when we're talking about kind of unpacking all of ERISA and really saying, wow, there's more than just, simple IRA and 401k.
Correct.
What else is on the table?
Well, there are a variety of different qualified retirement plans that are a little bit different than what might be known as welfare plans, which are your employee benefit plans, which offer health insurance and things like that. I know you've talked about that on some of your previous shows. However, the qualified retirement plan industry actually consists of plans such as profit sharing plans, money purchase plans, and we'll talk about that in a little more detail later. Those were very popular back in the 80s and 90s, and then with some of the legislation that's occurred since ERISA, but prior to the Pension Protection Act of '06, it's kind of mixed things up. But you've got profit sharing, money purchase, defined benefit, and now cash balance, which we'll talk about a little bit more too.
Do you think it's easier now, or is it much more convoluted and detailed?
Well, here's the thing is, obviously there are regulations, both preceded by the IRS as well as the DOL that govern these types of plans. And they are more complex from the standpoint of, as the years have gone by, the government wants to make sure that these plans are fair and equitable from an offering perspective to the participants of the plans. They want to make it easier for employers to actually offer the plans as well, because as you and I both know it, you look at some of the confidence factors as far as Social Security from a retirement perspective, it's not what I would call at an all-time high in any way, shape, or form. And traditional pension plans, as I know my father and mother worked for companies for 30, 40 years, and they had traditional retirement plans which gave them a benefit upon retirement age. It kind of changed a little bit in the 80s as far as 401ks coming into predominance, shifting the basically acquiring funds for retirement from the employer-sponsored plans to more like employee-sponsored. In a sense, I work for a company in which we have a 401k plan. I contribute to that plan, my employer, in a sense, employees have become more responsible for their retirement income than the employers of years past.
Now, one of the big thrills of almost all qualified plans is their deductibility. I mean, that's really the carry the day keynote issue. But when I'm thinking about after 2006, the Pension Protection Act, I mean, that world, there's a major seismic shift in the way we talk about it now, in the way we can say, because most of our agents are pretty good. A lot of people are FINRA licensed, or if they're not selling FINRA or security products, they also have the ability to sell indexing and fixed products. So they know what it's like to open up an IRA for their client, a SEP IRA. You know, if they've seen a small company, maybe they're overseeing their 401k and all these things. But when we're talking about adding things like, you know, cash balance plans, defined contribution, defined benefit, it seems like big issues. And then on top of that, now we're talking about group pension plan. It could be a scale of down to what? What's the minimum?
One person.
One person, all the way up to
self-employed individual, up to thousands.
So
exactly.
When we talk about introducing people to plans, a lot of our producers listening today saying, you know, I've always been a very good one-on-one guy, and I do have relationships with businesses, but I really didn't think I had the knowledge. How can I dip my toe into this and kind of see, because there's big money to be had here.
You're right.
So how do I make that migration from the single shingle kind of I only do one person at a time to maybe a small business, maybe closely held, to kind of dip my toe in the water, right? Some family business where I can kind of introduce some of the new concepts, not only of the 2006, but some of the stuff that stayed behind but got upgraded.
Okay. Well, a good way to introduce it is usually, like you said, if I'm dealing with the business owner or an individual perspective, if they have a company, if they're a sole proprietor or a business owner in any way, shape, or form, what you're wanting to make sure as any person who's dealing with financial plan is, do you have a plan for retirement? And if I'm with an IRA, you are limited into what you can actually deduct or what you can actually put into an IRA. Qualified retirement plans allow you to deduct more and put more money in a sense, saving more for the future. So probably an introduction for anyone would be to find out, number one, have they started saving yet? Are they interested in tax savings? A lot of times it begins with maybe a discussion that they've had with their CPA, or a discussion that you as the agent are having with the client themselves. You know what, I paid a lot in taxes last year. Nobody likes to pay taxes. No. If I can get anything that's going to allow me to reduce the amount of taxes I pay and allow me to save tax-free for the future, why wouldn't you want to be in on that?
I think everybody is enamored with the tax deductibility. Everybody's enamored with the tax deferral of qualified plans.
Correct.
There's always people thinking that in the old game, when I first came into this, I always assumed my retirement would be equal tax bracket. Like, you know, it would never be equal. It would be lower than whatever I'm doing in my earning years. But now, we're talking now in 2011. I don't know about that anymore. What's your take on that? Well,
you bring up a good point, and that's probably discussions that have happened since 2008, more so than any other time in the past. As you stated, the simplistic view was, well, my income is going to be lower in my retirement years, therefore my tax burden is going to be lower. However, with what's happened from an economic perspective in the last several years, you do have a lot of people that are worrying, well, with taxes going up, you know, how do I know what they're going to be 20, 30 years from now when I retire, or even 10 years from now? Am I better off waiting and not utilizing a tax-deferred environment, or am I better off paying taxes now and then having that money saved away? However,
well, what about the argument that people come up with, you know, because we're bringing up some basic entry thoughts today.
Exactly.
IRA, 401k. And what about, since we're talking about should I take the deduction, should I not, I need to bring Roth into this.
Sure.
As an introduction too. What about that issue?
Well, Roth IRAs have been around for a while. Obviously, Representative William Roth started them back in 1997. They were introduced, though, into 401k plans in 2006 with the Pension Protection Act of 2006. So as of that date, you could actually add a Roth provision to a 401k plan that allowed you to save after-tax money as well under the Roth guides, as opposed to just after-tax.
So is a Roth now somewhat deductible then?
Well, it's not deductible. What it is you still have to pay the taxes on it. In a sense, what happens is, in a 401k environment, what's called, I know, the 402G limit. I know I'm getting a little IRS code on you.
How deep can I go into the code today? That may be our question.
Oh, wait a minute. Let's not get too deep here. Let's kind of stay
402G, go ahead.
402G is actually the IRC code for the deferral limit for 401k plans. And currently in 2011, that's $16,500.
Now, I've heard rumors is that number bigger if you're over 50?
Well, if you're over 50, what happens is a plan can add what's called a catch-up provision, which allows anyone who's over 50 years old to put away an additional $5,500.
So $16,000 plus $5,500.
Correct, which would equal $22,000.
Okay, I'm doing my math here. Is it $1,600 or is it
$16,500 is the deferral limit right now.
So I'm looking at $22,000 if I'm over 50.
Correct.
Right now with a standard 401k, I can up my game and start putting 22 away.
As long as your plan has the catch-up provision in it, yes.
Now, but shouldn't they have? I mean, are you saying that?
Oh, sure, absolutely.
They should have it, but maybe not.
Sure.
Well, I'm trying to think about, when I'm looking at 22K for everybody 50 and over, and I'd have to say that's the ARP Nation, right? The entire ARP Nation. So if you're 50 and older, like I am, and you're part of the ARP Nation, this is the time to think about, hey, I can not only put away 22 grand or 16.5, but now I can put additional 5,500. Now, of course, we're just talking about the classic 401k here. We're talking about you could do much more in other plans, but we'll save that for another segment.
Correct.
But when I'm looking at the basic ideas of IRA, Roth IRA, 401k, do people do KEO plans anymore, or are they pretty much dead?
Well, and there again, I'm dating myself a little bit here. Back in the 80s, people would call KEO plans money purchase and profit sharing, which we're going to get into a little bit more in the next segment.
So I'm thinking, like, I haven't heard KEO plans floated by anybody, in a long time. I mean, that's the kind of thing where I think of, like, they're just changing all the names. I have to relearn it. If you didn't know this, that's probably a good thing. Listen, coming up in our next segment, we're going to continue with Susan on plan designs for group cases. I think this is part you need to integrate into your practice. We're going to try to let you dip your toe in the water. It's not as hard as you think. I mean, really, we're going to try to give you the introduction into this, and I think you're going to really enjoy it. You're listening to the Business Insurance Zone, a talk show that focuses on insurance in your practice. We'll be right back after this commercial break.
Steve Savant here. For years, I've heard that less than 2% of all term life insurance ends in a claim. That's not many, and clients had to die to receive the benefits. That's the old term insurance. Now start selling the new term insurance. The term insurance that covers your client through a chronic illness, a catastrophic event, or a terminal diagnosis, and pays their monthly premium during extended periods of unemployment. What term life insurance can do all that? Western Reserve Alliance Advantage Term with living benefits. No other term insurance product bundles so many solutions to life's unexpected problems. And all in one policy. So for more information, call Brokers Alliance 1-800-290-7226. Stop selling the old term. Start selling the new.
Well, welcome back to the Business Insurance Zone, the talk show that focuses on insurance on your practice. I'm Steve Savant, your host, financial color commentator, and interviewer extraordinaire. In this segment of the biz, we're going to be talking with Susan Hayek, our head of our pension department. And I want to say one thing, Susan, we're talking about plan design this half. We're talking about design features that could have tax and legal issues. So I'm not a legal or a tax person, so if you hear anything that Susan and I talk about, always check in with your attorney. And of course, if you're with a broker-dealer, always touch your compliance officer, make sure that they're cool with what you're doing. Remember, you can watch us all on all our shows on the Business Insurance Zone, on Vimeo, YouTube, the Insurance Newsnet, Agent Navigator, and of course, our own home site on our on-demand section, brokersalliance.com. Well, let's talk about a little bit about plan design. When I think of plan design, here's the imagery I get. I get this big blueprint. I get to roll it out. And now I'm ready to draw. There are so many options. You know what I'm saying? I don't know where to start. Most of our producers are going to be comfortable with basic Roth, basic IRA, even a small group, maybe 401k, small. But now we're going to try to expand our practice, expand the horizons, and talk about a few things because there's some serious money involved in this for our producers. So let's talk about design and who the ideal candidates are, because that's actually going to become our prospecting mantra. You know, whatever you say, Susan, is going to be our marketing mantra for who do we go out and look for.
Well, basically what you're looking for are individuals who are self-employed or small business owners. You know, your typical doctors, attorneys, CPAs. But that's been expanded recently, probably in the last 10 or 12 years, to include people that are in the IT business. There's a lot of people out there that are self-employed that do basically what's called 1099 work for other companies. And they need a retirement plan because they're not necessarily working for an employer that actually offers that.
Well, if they're 1099 and working for themselves, are they under the same caps like the 401k? Because that 401k, you know, I have 65. If I'm over 50, I can add another 5,500. Or no, they can get bigger than that.
Well, it all depends on plan design. And again, that's kind of what we're talking about. It depends on whether or not you're a sole proprietor, whether you're a C-corp, an S-corp, a limited partnership. It all depends on how your income is being derived and how that's being set up. That's one of the very first things that someone who does design a plan for an individual is going to ask. How are you receiving your income?
Okay, so a couple things I just heard you say. The entity, how I'm organized is an issue. That's one thing.
Very important.
Very important.
Yes.
How am I W-2ing myself and the few employees, or no, it's all 1099. And of course, is the IRS okay with the way you're characterizing the employment, right?
Correct. Again, like you had stated too, you always want to check with the CPA. It's always good to find out from the CPA, is it K-1 income? Is it 1099 income? Is it W-2? How am I actually receiving that income? Because what happens is typically what will be utilized as compensation for calculation of contributions, putting limits into course, is usually it's defined as W-2 income. Obviously, depending upon the entity type, you're going to define that in the plan document.
So in my head, I'm thinking pass-through, you know, S-corp, LLC, right? Closely held, maybe a partnership, right? I'm thinking in those terms versus C-corp, okay?
Right.
So now, a lot of guys that we deal with, guys and gals that are producers, are looking at a lot of small, like you said, closely held. IT, the guy's working out of he's got 2 or 3 guys working out of his basement, you know, something small. Am I under the same jurisdiction rules of 401k? Can I expand that to some of these really new, they're actually not new as far as what we're offering, but they've been upgraded since 2006 Pension Protection Act.
Exactly. Well, and really what you're getting at is, from a limitation perspective, what are the contribution limits that exist depending upon the type of plan that I'm trying to open? Those contribution limits stay the same for the individuals in the plan regardless of how they're receiving their income. It's a matter of how they're receiving their income, what income can be utilized to take into consideration to calculate that contribution that's going to be allowed for them.
Here's a perfect example. I just had this question a couple days ago where he says, I have a client that's working as a W-2 employee, always has been.
Right.
He's not in their plan because they don't match. So for whatever
he's
reason,
elected not
to defer because they don't match. But then at the end of the year now, he's concerned that he got money that he didn't intend to on a bonus already. So he says, what do? I know I'm going to have to pay taxes. Is there something as an individual, even though I am a W-2 employee and I've elected not to be in my 401k, what can I do?
He can actually open up an IRA, or what he can do is he could become a participant depending upon when that plan allows for participants to enter the plan. Some plans are set up where once you become eligible to participate in the plan, they allow you to enter the plan either on a semi-annual basis. In a calendar year plan, what's very typical is you're allowed to make changes and you're allowed to enter the plan on 1/1 or 7/1 on a calendar year plan, which is twice a year. Some plans, I can enter the plan at any point in time that I want to after I've met my initial eligibility requirements.
If he is past those dates and he wants to still get a write-off before the year, what's an individual over 50, what's his max in his individual IRA that he can do?
Well, in an individual IRA, I believe it's $5,500.
Total all in,
Yeah,
even if you're 50
it's not like a
or whatever.
qualified plan.
All right, but it's better than nothing.
Right.
Okay. So when I'm looking, if you have a W-2 and he also has 1099 income on the same person, can that person do something over here in their 1099 income, even though they might be in a 401k, or no, because they're that, they can't participate?
Well, sure they can.
Well, they can.
Absolutely. What they can do is, let's say I'm working for one company, I've got
W-2.
W-2 income, then I start my own company on the side. and I have income from that company. Technically, I could open up a retirement plan at my new company and start putting contributions in there. However, combined plan limits exist. I can't have, in a 401k environment, I can still only contribute $16,500. If I'm under 50, I can still only contribute $16,500 to all the 401k plans that I might be involved in.
So whatever the ultimate 401k cap is, including if you're 50 and older,
correct,
that's going to be whatever your tenant. They're going to look at both plans and not let you double dip. Well, basically,
in a sense, they're accounting for the fact that you, the plan sponsor of the plan, i.e. you, the individual, you need to keep track of that. And you need to make sure that you're actually keeping, because there's no way that your current employer would know that you might have established the other plan. So you, as the participant in the one plan, and potentially the plan sponsor of the other plan, would have to.
So the onus is on the taxpayer still. That's what I mean.
It's kind of like your 1040. You know how your tax preparer prepares it for you, but it's still your responsibility.
Who can read it? That's why I farm it out. Okay, you know, when I'm looking at plan design, I'm thinking of all the things, and you have this. If I wanted to order, I'm curious, and I think a lot of people will be. And if you want to ever write Susan, it's Susan dot, and I want to just spell Hayek because it doesn't spell like it's.
No, it doesn't.
I think if you're going to have a word, it should say what it is, right? Your name should pronounce it, but I'm going to do Susan's is Susan dot H. AJEK at brokersalliance.com. And her extension, if you ever want to talk to her, extension 149, just write us 1-800 or call us 1-800-290-7226. Do you have a menu where if I'm looking at all these plan designs, here is the potpourri of everything's out there? Do you have kind of a page or two that kind of says everything that's out there?
Actually, there are documents that do exist that give brief explanation as to the different plans.
And you have that?
Yeah.
So if anybody wants to write you, Susan Hayek, only it's HAJEK at brokersalliance.com, you'll send it to them.
We can get that out to
Excellent. What I'm thinking about, there's a menu of so many different aspects of qualified plan. I keep thinking small because I haven't really been a group guy myself.
Right.
And I need to expand my thinking here because there is a lot going on, and we could be really helpful for small employers all the way up to large corporations.
Right. And we kind of have been going back and forth between IRAs versus what we're here to talk about, which is the qualified plan. A little bit different. You know, IRA, individual, you're talking about an individual being able to deduct that. And there are a lot of people that still, depending upon their income, adjusted gross income, can contribute to an IRA and still get that deduction even if they're covered under a qualified plan. However, when you're covered under a qualified plan, you have higher deductibility capability, like a 401k plan. In an IRA, you know, I'm limited to that.
Well, when I think of IRAs and individuals, it seems like that's little to no cost. When I look at a group plan, I have this imagery in my head, that's big cost.
Well, you bring up a really interesting thought process there, because just recently there have been laws that have been changed that are requiring full fee disclosure. Now, originally those laws that were going through required that to be done this July of 2011, but they've been extended by the DOL to January 1st of 2012.
And the DOL is?
Department of Labor.
Department of Labor. They're on the dole. I love it. No.
No.
So I'm looking at the compliance issues you're saying. Basically, the fee structure. They have to disclose them.
Well, they're going to have to disclose.
They're going to have
Right now, it can be difficult for not only the plan sponsor, but also an employee to understand, what am I actually paying to be involved in this 401k plan? There are a lot of employees out there that think, I don't pay anything for my 401k plan that my employer has for me. But in reality, there are costs of actually allowing
beyond the investment.
Absolutely.
And the individual, not the employer, is paying.
Well, there could be, depending upon how the plan's set up, where it's located, who's the vendor, and
so there could be a benevolent employer. He's picking up all the fees, right?
Absolutely.
Okay. So when I'm looking at designs, some people are going to, once we know that everything's pretty much deductible on our designs, my next question would be then what's the most cost-effective plan? What really works for the employer? Because he's not just doing this maybe out of some of the benevolency of his heart, but he's also looking at the math. It's a balance sheet item.
Sure. And it is. Typically, I would have to say most employers will look at it as, I want to provide this for my employees as well. It's a great recruitment tool. It's a great retention tool. You know, anymore today, most people will ask, if you're asking them, do you have a 401k plan, or you know, is there a plan that's available? However, the employer, typically what they're looking for is, from a cost-benefit analysis perspective, is what am I going to get out of this, and what's it going to cost me? What is that cost-benefit analysis? And through plan design, using either one type of plan, and again, I'm going to throw some terms out here. We've talked a little bit about profit-sharing plans, obviously 401ks and IRAs, but when we're talking about qualified plans, profit-sharing, money purchase, 401ks, cross-tested plans, those are defined contribution plans that can be viewed as defined benefit plans, taking age into consideration to allowable deductible contributions for the participant and the owner.
It sounds like you could integrate some of these plans together and really top out if you want to.
That's the whole, that's exactly what a qualified pension would bring to the table to an employer or an advisor that's working with an employer, to actually look at that beyond the traditional, I can give you an IRA, I can give you a simple plan, or a plain old 401k.
Do you have a census or data collecting form that you use for all this?
Absolutely.
Okay, well, if you want this form, you can just call 1-800-290-7226. Susan's extension is 149, or you can write her at Susan. I'm going to spell her last name, Susan.Hajek@brokersalliance.com, and they'll turn in the census, and you'll give them their first blush into group. I love this. We'll begin working. Well, I want to remind everyone that you can contact me on my email address at thebiz@brokersalliance.com, or call me at 1-800-290-7226, extension 147, or hop out on our website at www.brokersalliance.com. I'm Steve Savant, and you've been listening to the Business Insurance Zone. Well, that's the buzz on the biz today. Get into the zone. The Business Insurance Zone.
This has been a Bravo video event of the National Insurance Clearinghouse and Brokers Alliance, one of the largest distributors of insurance products and services to a nationwide network of insurance professionals. You can contact Brokers Alliance at brokersalliance.com or 1-800-290-7226, extension 147.